Welcome back to the Wealth Hub IQ. Today we're going to be defining exactly what a mortgage is in the most simplest form to not overcomplicate the meaning. In the simplest form, a mortgage is just a loan. So you know when you go into a bank and you ask your bank for a loan and they can give you a loan based on your eligibility and your criteria and how much you're asking for. Think of a mortgage as the exact same thing, just a loan. Now, the reason why we don't just call mortgages loans is because mortgages are loans secured by a piece of real estate. Now, that piece of real estate is the key component here. So the real estate is the collateral for the loan. If that went over your head, don't worry, I'm going to go into a little bit more detail and explain that in its simplest form. With a bank loan, if you default, which means you fail to make the required payments, the bank considers you a higher risk for future loans. That's why anytime we have any type of loan or overdraft, we always try and pay it back before the deadline. If you're unable to repay the loan, this can lead to being blacklisted or having a lower credit score, making it harder to borrow money in the future because you were unable to keep up with the payments. So that's the basics of a bank loan. Now, in relation to a mortgage, if I lose my job or stop paying towards my mortgage, then the bank can take the real estate from me and use the real estate to repay the mortgage loan. That way, the bank doesn't lose money if someone dies or loses a job or can't repay the loan. So to go back to the top, the reason why mortgages aren't just called loans are because mortgages specifically have a piece of real estate secured to it, so that if anybody was to default on their repayments, then the bank would be able to take the real estate from that individual in order to make up the remaining payments of that mortgage. So why is it every single time everyone's talking about buying a home, they always talk about buying it through a mortgage? Why don't they just go out and buy the house themselves? Well, let's look at the figures. The average house price in London, England is £722,597, and in Los Angeles, LA, California is $1.2 million. So unless you have that type of money lying around underneath your bed, you may have to consider taking out that mortgage for the dream home you've always dreamt about. Mortgage terms range from 10 to 40 years, but 15 to 30 years are the most common mortgage terms. The longer the term of the mortgage, the lower the monthly repayments, which is another way of saying the more years you add to repaying your mortgage, the lower the monthly installments are because the bank can spread the cost out for a longer period. Let's use an example here. If a bank gave me a loan of £10 or $10 and the repayment amount was £1 a day agreed by the bank and myself, this loan would take me 10 days to pay back in full and clear my debt. However, if the same bank were flexible with me because I'm a loyal customer and I've been with the bank for a long time and said the same £10 that I owe can be paid at a repayment amount of 50 pence a day or 50 cents a day, this loan will take me 20 days to pay back in full and clear my debt. So this is the same way banks are able to spread out the costs of the monthly repayments of their mortgages. However, as customers, we get lower monthly amounts. So again, what is a mortgage? A mortgage is a loan you take out to buy a house. You agree to pay back the loan in monthly payments over a set number of years, usually with interest added. If you don't keep up with the payments, the lender can take the house back. Thanks for watching and subscribe to the Wealth Hub IQ for more videos.